In this video, we're going to talk about how to identify high probability setups and how to find high probability setups using price action rules. Because as price action retail traders, our job is to follow institutions, the big players who are moving the market. Best thing we can do is try to use price action rules in our favor and try to follow the footprints of these big players. So we can see that during pre-market structure, prices created a big two-legged pullback. This is important because market likes to move in pairs of twos. Two-legged pullback under the right context is a high probability setup. And we had first bullish leg, correction, second bullish leg to the upside. Now we have a shortened uptrend, break, and a new extreme telling me that after a new extreme, I expect correction or possibly reversal. Now notice that this move up is quite substantial. So what I can do, I can potentially try and draw a wider uptrend, but this right here feels quite too wide. And when I'm going to abandon this idea, I'm going to abandon this idea somewhere around this point once I'm paying attention to how exponential moving average keeps holding price. When I'm looking at the chart and I see first break a new high and I see strong push below EMA, I'm paying attention to whether I can get reversal pattern, and I can see that the EMA keeps rejecting prices consistently. And by the time there is a big last bearish leg working lower like this is where I'm going to delete this uptrend and I'm just going to focus on the shorter term price action. Break new high, two big legs up, and this is looking like a trading range for the most part. This is not a bullish uptrend to start with. So as I see prices pushing lower, right now the current structure of this market is bearish downtrend. So what I'm going to do, I'm going to try to locate some form of a pattern because we just had a break, a new low, but prices keep creating multiple legs to new extreme. So what I did, I located a channel like this. It fits off the highs, it gets nicely confirmed right here. And I'm doing this because I want to find a key entry point where high probability setup may appear. And notice what we have. Right now I have bearish structure working lower. Prices are below EMA indicating bearish momentum. Uptrend played out with the break and a new high. So right now I expect to get a high probability setup at the key entry point. And this is a two-legged pullback or failed second entry long. And notice what I have. This is the lowest low where I reset the count, where I start looking for high probability setups. Now we have a new low and we have first attempt to sell. Once prices broke below this bearish bar, pullback, second attempt to sell. This is the second entry short. But notice why it is not a great idea to take the second entry short and why did I skip it? At first, you're watching the short-term uptrend and you can see that it has a break and a new high. So from the short-term perspective, I can see uptrend playing out, which is telling me that I can go short. But important thing here is to understand that the bar is still not close enough to exponential moving average nor the trend line. And this is important. This is not a healthy, strong downtrend. This is not one of those very strong downtrend days. This is looking like a trading range structure overall, and overall it's looking very sideways. Look at the previous price action, not really particularly strong trend. So once I see second entry short, still not touching key entry points, I'm going to be patient and I'm not going to take an entry. And notice you did the right thing if you stayed patient here. This is why we wait for prices to pull back. If I'm in the trading range structure, if it's a healthy, strong downtrend, prices just kept selling off consistently, strongly, I can take a risk on entry like this, but not in this structure. Now there was a longer uptrend which had a break and a new extreme. In this particular instance, you don't want to go long just yet. You don't want to go short because you're above EMA. Only thing you can do here as a price action trader is to wait for market to give you a clear signal of what it's doing. And once prices pushes back below exponential moving average like this, is now indicating to me that the bearish structure is resuming. So not only I expect new low for this downtrend, I also have my low of the day key level marked. And you have to mark these low of the day, highs of the day, because they're a lot of times the target. So once I see prices pushing low like this is my first target, and I expect for prices to go all the way down to this low. So what I'm going to do, I'm drawing the shortened downtrend as well, because this is quite now a looking strong downtrend. And I'm looking for two-legged pullback at the key entry point. And notice what we have. New low formed, first entry short, move higher, second entry short. So this is a second entry short in the bearish structure of the exponential moving average, but I have a shortened uptrend in play. I cannot take this entry. So you guys can see I have a two-legged pullback here and two-legged pullback here, yet I'm not allowed to take this entry if I want to follow my rules. I need to sit patient and I cannot take this entry because shortened uptrend is in play. Even though EMA keeps holding price and at this point the bias is looking strong bearish, I respect the structure and I'm just waiting, and prices never came back and tested the EMA before we eventually reached new low. So as I was watching this, I had to reassess the structure and I figured that there may be a potentially larger downtrend, something like this, because we kept pushing lower consistently. Notice you have a small little overshoot, which a lot of times leads to a break of a channel or straight up reversal. Also, since we are coming from the low of the day key level, a lot of times what will happen once prices take their time to get all the way down to the key level, that the prices will hover around the key level and it will go and result into trading range structure. For that reason, you cannot really take premature short, and you don't really want to go long either, because you're right now in a fairly strong bearish downtrend. So I'm counting, I have a new low, I have a first entry short, second entry short. That is not the key entry point, and I have a shortened uptrend in play. Price push below EMA and form a lower high setup, confirmation of a two-legged pullback, and now price is pushed below EMA. But this is quite tempting entry, because when you're looking at the right side of the chart like this is quite a decent downtrend. And look how bearish this looks. But it first strongly pushed above EMA with the bullish bar, and EMA kind of got in the middle of these bars. It got a little bit too stacked here. Had we closed right below EMA, I would have liked it. A little bit aggressive, not a bad entry at all, but also this uptrend needs a new high. A little bit too early. You need to fill second entry long below EMA in this instance, and you never got it. Price bounced here and pushed strongly to the upside, and you're now back above the EMA, and now you only have first entry short. And right now you're basically going sideways. Take a look, EMA in the middle of these bars. This is right now a sideways movement. This is where it's going to get confusing, because you have two conflicting patterns, the downtrend or the key level. So what is going to work in this instance? I'm asking myself which side I'm leaning more towards. Of course, I'm leaning more towards bearish bias, but I still have to be careful because we just bounced from the low of the day, important key level, which may come into play a lot. You guys can see it's coming into play even at the end of the day. This is why it's so important, and price action is so reliable. You draw it at the very beginning of the day, and it will give you an idea how price is reacting throughout the day. Now, prices form a break, new extreme. So when I'm watching this, I see kind of like a first move, little like this, second move to a new extreme. And why I'm still leaning towards bearish bias? Because this was a strong, fairly strong bearish downtrend. So right now I have a first break of this downtrend. So according to price action rules, I expect for prices to create new extreme. Overall bias is still bearish, and a strong push below EMA is telling me that the prices are bearish. Uptrend played out with first major leg, correction second major leg. Strong push below EMA confirming the momentum, and we have new high, first entry long, push below EMA confirming bearish momentum, second entry long, failure. Now we had a failed second entry long triggered on this bar right here on an engulfing entry, but you cannot take this entry because notice how far away from EMA you are. There's a big gap between exponential moving average and the bar you would have entered using engulfing entry. And this is a reversal pattern trap, and you don't want to go short here. Instead, prices pull back a little bit to the key entry point, and now this is a proper failed second entry long. But notice what you have, a bearish bar, half of the body is thin, it's too big. I was about to go short here and take my first trade for the day. I didn't want to go short below bullish bar. I waited for this bearish bar. I was hoping it's going to close small, and it closed this gigantic with such a stim, and you don't really want to go short all the way down here, even though it would have worked even with the limit order. Too risky, too aggressive. I'm only marking it as an example because you expect new low for the downtrend. This is the first break, and overall bias is bearish. So I'm waiting for a high probability setup. I cannot pick top a random trade. Lower high is still above EMA. Now prices push below EMA and gave us a failed second entry long. We didn't reach the low of the day just yet. We don't have a new low just yet. New low formed, first entry short, pullback, second entry short. Now this short right here is a little bit aggressive because it closed above exponential moving average, but I can treat it as a little bit of a failed breakout out of this congestion. This is a stacked area with multiple bars stacked, and you broke higher. You have a double top, big bearish bar, and downtrend still needs to new extreme. The major downtrend still needs to new extreme. This is quite aggressive entry. Beginner trader should probably avoid this, and this is only for advanced trader who has some experience under his belt. But notice that the bias is still bearish, and I'm using price action rules to still keep me on the right side of the market. Prices are swinging up and down, so I'm going to draw the trading range. But right now, prices form a double bottom and a strong reverse up. Now, I still treat this as a trading range. If I'm going to zoom out like this, notice there are still no signs of a bullish activity. We traded down, and we are right now correcting it. So we traded down into this trading range. So as I'm looking at the structure, I have a new low, I have a first entry short, pullback, second entry short, and I have a second entry short, basically a lower high. This was my first trade for the day, and I took it on engulfing entry. Once price broke higher, it instantly was reversing down, telling me everybody who went long here got trapped. A little bit aggressive because engulfing entries are mainly for traps. You don't want to go short below such a big bar into these lows. You have to make sure you have enough room to these lows. So this was a little bit aggressive. I took a chance here. It worked, but I was treating it as a second entry short and lower high and downtrending the new low. That didn't happen, and market kept pushing higher and reversing above exponential moving average, which is indicating to me that something was changing here. We probably formed a double bottom, and that is enough. We're most likely not going to get new low. And right now, as the market is reversing, I cannot take any entry just yet because we are in the middle of this trailing range. There is no decent entry just yet, so I'm right now just sitting patient on my hands, not really doing anything. Prices are breaking higher, and when I'm looking at the structure like this, downtrend into a trading range, most breakouts of trading ranges will fail. But I have a shortened uptrend in place, so I cannot just pick a top and fade the breakout. Now, this uptrend is working higher, and right now you may be asking question, hold on, aren't we supposed to get a second entry long here, a new extreme? And the answer is no, because first big leg was down, then we bottomed out and formed a trading range, and most breakouts will fail, so I'm leaning more towards price testing again this breakout area. Because once we broke above this resistance, prices never came back. When I was watching this, I expected for second entry long to fail. I'm going to draw my shortened trend line, and as long as we are inside of this channel, I consider this downtrend valid. And notice we have new high, first entry long, pullback, second entry long, failure. Great bearish bar. This was my second trade for the day, and I had to sweat this trade a lot. I took this trade right here. It's 1, 2, 3, 4, 5 bars before it eventually got my scalp and my runner got eventually stopped. But this was really nerve-wracking trade. It was stressful. When I was watching this, I was really contemplating entering a break-even, because you enter a trap, and the trap is supposed to tell you that you caught the right direction and people on the other side got trapped, meaning everybody looking on a second entry long for a new high is wrong, because we're going to pull back into this trailing range. And overall bias was still bearish, and we are inside of this channel and we're below EMA. We didn't push lower, created a bullish bar, doji. It kept stalling, it kept stalling. It really looked like it's going to stop me out. Once you enter a trade like this and you are in this position, what your mind will do, it will start doubting your trade and it will start doubting your analysis. And this is where you have to come in with the strong will. You have to analyze, why did you like the trade at first? You cannot scratch the trade too early. Now, I will say this, we normally don't exit at break-even. The only acceptable scenario when to exit the break-even is when prices gets into a long congestion, and you can characterize this as a long congestion. And I saw a lot of traders got out at break-even, so I can understand why. And it's nothing too wrong taking a break-even here, because it really took a little bit of time. But when I'm watching a trade like this, I've done my analysis prior and I like the trade before I entered. I have a set of rules that I follow, and if I want to make consistent profits, I cannot monkey with the trades and I cannot break the rules. If this is a trade that I like and I think it's a high probability setup, we're going to pull back, I cannot get shaken by prices stalling a little bit, and I need to really trust my read and trust my rule. Anything can happen. I can easily get stopped out. I count with the option anyway. Before I enter trade, anything can happen. So I already priced that in. I like this trade and I'm going to stick with it and I'm going to ride this out. If you are a trader who's trading live for quite some time, can exit this at break even. But if you are a developing trader, a beginner trader who is just trying to learn, don't exit trades early, because you want to feel the pain. You want to look at this trade and you want to get stopped out so you can learn from this. You learn the most from the losing trades and you learn even from the winning trades. But what you don't want to do, you don't want to keep consistently taking break evens, scratching trades all over the place, because in that case, this will get mixed up in your mind and you will never truly remember the pattern and you will truly never learn from it. But once you sit here 10 minutes stuck in this trade, and if it gets against you and you get stopped out, this will really get deep in your mind and you will remember it till next time. So just take the entry, do your analysis prior, and don't monkey with the trades. Don't try to exit too early. Don't move your stop loss. Don't move your target profit to take a smaller portion. This is just telling you that you didn't accept the risk of the trade. Every single time you catch yourself moving stop loss a little bit too closer because you don't want to take full hit, or you're taking the target profit close, so you want to get earlier out of the trade. Your target profit is set to 8 to 10 ticks and you're moving into 4. That is telling you about yourself that you didn't accept the risk of this trade, which means you really didn't accept the nature of trading. And trading is about probabilities. There are going to be losing trades, so never move this stop loss. Just put it there. If you cannot watch this trade, look away and come back in 5 minutes and see if you get filled or not. That's one of the exercises that a lot of traders have to do, because they cannot just sit here and watch it go sideways like this. And it was a nerve-wracking trade. I was sweating a little bit as well. But in order for you to learn, you cannot scratch the trades early. You need to have a winning trade or a losing trade so you can remember the pattern. Downtrend had a break, new extreme. We tested the breakout area, and if anything, it held and formed a double bottom. And now my bias is changing, because we tested the breakout area, and instead of prices pushing back into a trading range, it is holding and we're pushing back above the EMA. So once we push back above the EMA, it told me that the bias is changing and we're probably going to get a new high for this uptrend now. Downtrend played out with the break and new low. Double bottom, strong push above EMA indicating bullish momentum, and we have nice high low after double bottom. EMA keeps holding price, decent signal bar, and then price even created new low, first entry short, second entry short failure, which I'm going to mark as slightly aggressive because the momentum was really there. They really got them trapped. This is a nice bullish bar. It is off the trend line, it's just not right at the EMA, but quite a decent entry. Prices formed a new high, and now prices went into consolidation. And there's a possibility for you to draw uptrend like this. Why I'm not a fan of this uptrend and why I didn't draw it. First of all, if I'm going to zoom out, I see major downtrend, bottom trading range, and we just broke higher. And to me, this is looking like we may eventually create a second leg continuation down somewhere along the way, and we try to make the second leg eventually. So this is not really a place to look for reversal once we just move down to a trading range, and it doesn't really look like a strong uptrend, because in a strong uptrend prices are supposed to swing up and down, but here you can see that the highs are static. The move to the upside is getting weaker and weaker, and the upper portion of trend line is completely empty. I saw this as a triple top. I saw this as a wedge. This is a wedge pattern. Trend line, key level, and it's heading into a wedge. Right here, this is more like a triangle structure. We just moved from the bottom trading range into upper trading range. EMA is still for the most part flat. I see break a new high. I see new high, first entry long, pullback, second entry long, failure, reversal pattern, a good easy scalp. There was a last push to the upside, new low, first entry short, second entry short failure, which I saw a few traders took. But like I mentioned, the triple top is concerning. This is really looking more like a trading range. This is not particularly strong uptrend. Double top, first entry long, pullback, second entry long, failure. This is a failed second entry long that pushed below EMA. After triple top, this is a decent entry. This would have ended up being a losing trade. But if you're price action trader following the rules, you're taking a high probability setup, and it definitely seems like one new high, first entry long, second entry long, failure. And notice you even have triple top, uptrend played out. There's no reason to be looking for longs. If anything, it's just a matter of time before you're going to reverse. And in this instance, there was just a little fake out trap, just a couple ticks higher, stopping everybody out, and then eventually they took it lower, which you cannot predict. You have to follow the rules. Now, as I see prices pushing lower, my expectation is for market to move all the way down here, because from this perspective, this is just a two-tier trading range for the most part, something like this. So this is like move down, move into a trading range, and I expect for prices to give me a second leg down like this. The first major leg correction and the second major leg down. So this is how am I approaching this, and this is why I expect for prices to go all the way down to this support. Today was not particularly easy day to trade, especially throughout this area. So if you're unsure like this, the goal is to follow really the short-term structure and short-term price action, because high probability setup will appear. There was a break, new extreme formed, but bias at this point on is still bearish. I still expect market to go all the way down here. So I'm just going to watch prices and the EMA. I have a break at a new high here. So there's a dilemma. Am I going to draw a wider pattern like this, or am I going to stick with the short-term one? I'm going to pay attention to the EMA. I'm leaning more towards the short-term one with the break and new high, because we're coming from highs, we're heading down to these lows, and once prices push strongly below EMA, like this told me the bias is truly bearish, and now I can take a failed second entry long, and we have new high, first entry long, second entry long, failure. EMA keeps holding price, high probability setup. So this is how you're basically playing the indecision, the confusing structure. It's quite all over the place, but you're paying attention to the short-term channels and mainly how EMA keeps reacting. You always need to zoom out, remind yourself the bias, and the high probability setup will eventually appear. Now market pushed higher, double bottom, EMA is getting flat, it's no longer pointing down. There's a new low, first entry short pullback, second entry short, which ended up working. You wouldn't have gotten stopped out, but you have to go short directly into EMA without new high of the uptrend. Uptrend may get a new extreme. I don't really like shorting here just yet. It's a little bit too early. The idea to go short is not wrong, but it's a little bit too early. And as the prices are right now pushing lower and breaking this support, this is where there is a possibility to draw a wider channel, something like this. You guys can see multiple confirmation of the highs. It's getting confirmed right here, and this is right now a fitting structure. It gives you an idea that there are a series of lower highs and lower lows, and once I see this, I'm expecting to get a high probability setup at the key entry point, and a high probability setup is a two-legged pullback or failed second entry long. Prices form new low, first entry short, little pullback tick higher, and a second entry short, two-legged pullback, uptrend played out with the break in new high. EMA keeps holding prices, and what's better, notice this is a breakout pullback pattern. You broke below this support, now acts as a resistance. It is a breakout pullback, two key entry points, second entry short, uptrend had the break in new high, high probability setup. So this is what you do. You just wait for prices to give you the clean high probability setup, and you have to be patient throughout these areas where you're unsure. There was a correction, break, new high, first break of the downtrend, indicating that you're most likely going to get new extreme for the downtrend following the price action rules. And there is a new high, first entry long, pullback, second entry long, failure. But this bar is gigantic and you pushed above EMA. So you could have added this, but it's a little bit too risky. What you can do, since this is looking like a part one leg down, you can kind of treat it as a visual two-legged pullback, new high, like a first leg, pullback, second leg. This is what I mean, first leg down, second leg down. So on a larger visual frame, you can treat it as a first entry long, second entry long, failure. Right near the EMA, big bearish bar, downtrend needs to get new extreme was formed, and after new low, we expect correction or possible reversal, and notice price entered the trading range and eventually reverse. So these were my two trades for the day. This second entry short lower high, and this failed second entry long right here. No runner on both of these, and I didn't take any other entry after that. If we zoom out, we can see overall the bias was quite bearish because this was the highest high of the day, and from that point on, prices created a big leg down, just corrected a little bit but failed to reach the high of the day, and again continue pushing lower, indicating bearish bias. So I hope you had a decent trading day, and I hope the video was educational. I'm going to see you guys in the next one. Take care, everybody.